Good afternoon. I'm Joshua Van Gestel, National Education Manager for Sunsuper, and I'd like to welcome you to today's webinar, Investing in Volatile Times. We appreciate that times are difficult, and we also appreciate that many are actually in financial stress or concerned about what's happening not just around the world with COVID, but also the impact on the economy, including the impact on their super. We at Sunsuper are very committed in looking after your savings for retirement to ensure that you get the best retirement possible. And please know that we are focused on that task, and it is something that we are very, very aware of in making sure that you are comfortable and that you're also aware of what we're actually doing. Before I do start on today's seminar, and apologies, before we do start today's webinar, please be aware that the information we're sharing is of a general advice nature only. So it's very important that anything that we go through today, that you actually consider that in terms of your own financial situation, your own needs and your own circumstances. You can contact us on 13 11 84 if you'd like to discuss anything that we raised today, or speak to your own financial advisor where you have one. We also encourage you to visit our website, sunsuper.com.au, for further information, including access to product disclosure statement documents. So today I'm joined by Brian Parker, our Chief Economist at Sunsuper. Brian has been very, very active in recent weeks and months in actually talking to our members and talking to consumers more broadly about what's going on with the economy and about its impact on the members' savings, not just at Sunsuper, but more broadly in the superannuation system. I'll hand over to Brian in a moment, but before I do, we are this afternoon putting you on mute as you join this webinar, and that's to ensure that we can actually cover the content that we've got to get through, but also make the experience as easy as possible for all those that are dialed in. We have, though, made sure that the content we're providing to you this afternoon does acknowledge a lot of the questions, concerns and feedback that we're receiving from our members. So we're sure that the content will address many of the questions that you yourself have. At the end of this, we will actually give you details as to where you can get more information and where you can go for further answers should we not cover them within this webinar today. So there's four things that we will be discussing over the course of the next 35 minutes or so. Firstly, I will hand to Brian to give an investment update, to look at the economy, look at what the impact has been of COVID over the last few months, but also to look at what the impact has been on the way that we invest at Sunsuper and the considerations and observations that we actually have. Secondly, we'll talk about how this actually translates to your own superannuation, what the impact is on your savings and what the considerations are that you should be making. And on that, we'll actually talk about the decisions that you do make in volatile times. Things that you do now can have a very long-lasting impact. We've seen it previously and we will see it again. So it's important that the decisions you make, whether that's making an investment choice or perhaps even considering withdrawing some of your super, that in those decisions you're aware of the weigh-ups and also can consider the long-term effects. And finally, we'll end by actually giving you further information on where you can go for additional support if you need any further advice or direction following on from this webinar. So on that note, I'd like to hand over to our Chief Economist, Brian Parker.
Thanks very much, Josh, and thank you everybody for dialing in this afternoon. I'm going to start by talking about the global and Australian economic outlook and also touch on what all that might mean for financial markets and for the investment outlook. If we talk firstly about the global economy, it's almost impossible to imagine how the global economy could avoid a very, very sharp recession in the first half of 2020 that really, given the disruption of the COVID-19 crisis, and not just the spread of the virus itself, but the measures put in place to limit the spread of the virus, these have had a really dramatic impact on global economic activity. So we are going to see a very, very deep fall in output and employment across much of the world before we eventually get a recovery. And make no mistake, we will get a recovery. But at this stage, we believe that recovery is going to be very drawn out, very gradual, and very uneven. That the performance of different economies around the world in that recovery phase is going to be very diverse. More about that shortly. It's important also to bear in mind that as we went into this crisis, we were actually in an environment where the overall fundamentals of the world economy were actually not that bad. And that actually does stand us in somewhat good stead for the recovery phase. That the private sector was in reasonably good financial health in most economies around the world. The banking systems around the world were reasonably strong. And so that actually does put us on a good footing in a way going into this crisis. Another reason for some optimism here is the response of policymakers. That fiscal policy and monetary policy around the world, the responses have been very, very aggressive and for the most part, very, very fast. However, on balance, we think that how efficient those responses are going to be, how powerful they're going to be, again, will vary across countries. Just how well these policy measures, especially on the fiscal side, how well they've been implemented will vary very considerably across countries. And on balance, we also think that there are a number of economies around the world, most notably the United States, where there will be more work to do to help ensure that economic recovery. Now here in Australia, again, given the disruption of the COVID-19 outbreak and the measures put in place to deal with it, it's highly likely that we will get a significant recession in the first half of 2020, again, before we experience a gradual recovery. We're likely to see unemployment rates rise to quite significant levels, close to 10%, if not higher, before we eventually see that recovery start to put people back to work. The measures that the Reserve Bank initially and also the government put in place have been very, very significant. If you look at the quantum of the dollars involved, it's a very, very large fiscal stimulus. However, we are somewhat concerned that so far the amount of money that's on offer from governments, while the dollars themselves sound very large, money may not hit people fast enough to really, in other words, money we think is flowing too slowly, and there may still be more work for governments to do. Now on the next slide, let's talk about what this actually means for financial markets and for strategy. Now, as dire as the world economy is looking, and as catastrophic as this outbreak is, it's also important to take a step back and remember that every crisis tends to create opportunities. And ultimately, we get paid to take advantage of investment opportunities that come our way, and we take those opportunities on behalf of members. And we think this crisis is going to be no different. That there will be investment opportunities that will emerge over the coming weeks to months. If I look at share markets, we've seen a very, very sharp fall in share prices, although we have seen a correction recently. But now share markets are looking very, very attractive as an investment, especially when you compare it to the future returns on offer from cash, from term deposits, and from government bonds. Interest rates on offer on deposits, yields on offer on government bonds are just at extraordinarily low levels, which suggests that the future returns there are going to be very, very modest. We will see continued opportunities emerge in our alternative asset classes, in the unlisted asset classes in particular, of property and infrastructure and private equity, and we are well placed to take advantage of those, subject to one very important constraint. We also need to make sure that our fund is prudently managed, and especially given the attention that's been focused of late on the liquidity of major superannuation funds, it's important for Sunsuper members to know that we are in a very, very strong liquidity position, that we have ample liquidity to both do what we want to do as an investment team, to capture opportunities that will inevitably emerge in the crisis, but also make sure that we have liquidity on hand to meet members' demands for liquidity. and that might mean members desiring to switch into cash. We have seen a lot of that activity over recent weeks, but also members that want to take advantage of the government's decisions to allow a greater opportunity to release your superannuation early and during times of financial hardship. And rest assured, we are well placed, very well placed to meet members' demands for liquidity. If I look at the next slide, I think it's important also to put this current crisis in some perspective. This is really something that we have, the world economy and world markets, we've really not seen anything like this for over 100 years. You really need to go back to the outbreak of Spanish flu to see an outbreak that is so widespread and has such profound economic impacts, and also has the potential to cause such incredible amounts of human misery. And so far, we have seen, at the time we put this presentation together, just over 200,000 fatalities from COVID-19 around the world. There is clearly more to come. So again, this is not anything like the kind of financial or economic crisis that really any of us have seen in our lifetimes. And it's important, I think, to bear that in mind. If I go to the next slide, in terms of the impact on markets, this chart just shows you a measure of market risk appetite. It basically is an index that adds up or tries to average out the performance of a range of higher risk assets, including shares or high yield bonds in particular, and also the performance of key risk indicators, such as the Australian dollar, for example. And what it shows you is that whenever you see this line take a big dive, it means that markets are moving into panic territory. And the speed with which markets moved into panic territory was really quite extraordinary on this occasion, much faster and even deeper than the retreat that we saw during the GFC. But go to the next slide. This has also started to have really significant economic impacts, initially on China. So this is just a measure of business conditions in China going back to 2005. The fall that we've seen in Chinese business conditions is far, far worse than the fall we saw during the GFC. Now, since then, you've started to see Chinese economic activity start to rebound. It's rebounding off quite a low base. In other words, it'll take some time before the Chinese economy returns to anything like what you might call normal conditions. If we look elsewhere, if I look at other countries around the world, if we go to the next slide, Josh, if I look at other measures of business conditions, this just shows you some other global measures of business conditions. So on the left, we've got measures for the world and for the developed economies and the emerging economies. And on the right, measures of business conditions for manufacturing, services, and the overall economy. Now, the way to read these charts, I should say, 50 is neutral. 50 basically means that the economy is neither expanding nor contracting. And that sharp fall that we've seen in recent months has really been unprecedented, certainly far worse than we saw during the GFC. If I turn to Australia on the next slide, if we look at business conditions and Australian consumer confidence, again, we've seen a really very, very sharp fall. And the chart on the left shows you the weekly consumer confidence survey published by the ANZ Bank and the Roy Morgan Research Group. Very, very sharp falls in confidence, really mirrors the experience of the early 1990s recession, although arguably the fall happened a lot faster. Since we drew this chart, confidence has retraced a little bit. We've seen a bit more of an improvement, perhaps an expectation of the measures that the government have put in place, but still confidence remains quite depressed. The chart on the right shows you the National Australia Bank's measure of business confidence. And once again, you've seen a very, very sharp fall in confidence from business. And none of this is the least bit surprising, given that what we are going through is truly unprecedented, certainly in modern economic history. If I go to the next slide, if we can look at the policy response, governments are mostly stepping up, but we fear that more will be needed. Now, this is just trying to put the fiscal policy response from different governments around the world in some perspective. It doesn't say anything about how fast money can be put to work, but it does give you a guide as to just how much money has been put on the table by governments around the world relative to the size of their economies. And again, this is just based on the latest available data we have. The response from the Australian government actually exceeds more than any other country shown on this list. So we have actually, in terms of the amount of money on offer, it is very, very significant. We still have some concerns that it may not be reaching people's pockets fast enough, but certainly we are likely to see a significant sum of money injected into the economy and it's here in Australia over the coming weeks to months. The other important point to note is that there is almost certainly more to come. The United States comes second on this chart. There's been considerable doubt about how efficiently some of the measures the US government have put in place, how efficiently those measures can be implemented, and it's highly likely that another round of stimulus will get through Congress over the coming weeks. If I go to the next slide, another important distinction this time round is just the composition of what governments are doing. And this is quite pleasing. This is not this is not like anything we've experienced in modern economic history, and it calls for a different response from governments. And the pleasing thing is that a large percentage of government's response to this crisis has been aimed on really achieving two things. Firstly, putting money into people's pockets as quickly as possible, rather than do things like construction projects or infrastructure projects, because frankly, they won't affect the economy fast enough. A lot of the measures that have been put in place have been about putting money into the pockets of households, but also ensuring that businesses can keep as many people employed as possible. And so if you look at what I've done is really divide up the composition of what governments have done to stimulate the economy right now into different categories. And I would just focus, if I could, on the light blue, which is job retention measures. So this includes things such as the JobKeeper program the Australian government has put in place. That accounts for the lion's share of Australia's response. Now, there is some question about exactly how many businesses will both qualify for this package or how many will actually end up signing up for it. But it's likely to see a significant amount of money injected into the economy and a lot of people remaining employed who otherwise would not be employed during this crisis. Other governments, such as the UK, for example, and also in New Zealand, have done similar things, but not in the same scale that we've seen here in Australia. We've also seen significant tax cuts, and so I'd say that on average it means governments have done a reasonably good job of ensuring that their response to this crisis is appropriately tailored to the nature of the crisis. The next slide, if I could, Josh. I've mentioned in the introduction just how the recovery, when it inevitably happens, will vary a lot across countries. And I think there's a number of factors at play here. You know, if I ask the question, what will determine success in an uneven global recovery, here's a short list of factors. Firstly, just how large and how effective the economic policy response will be. Just how quickly and how deep is the decline in economic activity. How successful will governments be at keeping the infection under control? And, you know, how effective will they be at limiting the risk of resurgence of reinfection over the coming months? Also, trade linkages are going to play a part. If your trade is mostly with countries that are still struggling, then you're not likely to benefit as much in recovery. Australia, for example, here is relatively well placed. The fact that the Chinese economy is gradually returning to normal, although it is a gradual process, does mean that having our trade more closely linked to China should be a big positive for us in the recovery phase compared to, say, having our trade mostly with really struggling countries like the UK or Italy, for example. Labour market flexibility. How quickly can employees be brought back to work will also be a success factor. And also financial stability. How quickly can some of the financial measures, some of the monetary policy measures that the central banks have put in place, how quickly can that transfer through the banking system and into the real economy? If I go to the next slide, I just wanted to touch on investment strategy, if I may. Those of you that have come to our seminars or read our investment material would know that a key competitive advantage for Sunsuper and a key source of our investment edge over time has been our ability to maintain relatively higher levels of unlisted assets, property, infrastructure, private equity and alternative strategies. Relatively higher levels of these alternative assets than many of our competitors. And the reason we hold these assets, it's a core part of our investment philosophy and beliefs, is that over time we find that these assets deliver higher long-term returns for members, but they're also less exposed to major downturns in financial markets and particularly in share markets. And this time round, we believe is no different. And I thought it would be instructive to look at the experience of the global financial crisis, to see how Sunsuper's unlisted and alternative asset classes fared during that crisis compared to the performance of traditional asset classes, particularly shares. And this is what this chart shows. Now, each of these different classes of assets, this just shows you just how bad did they get during the GFC. What was the maximum drawdown? What was the maximum fall in value, peak to trough, during that crisis? And the timing differed for each particular asset class, so I've allowed for that. And what it shows you is that all of Sunsuper's alternative asset classes, property, infrastructure, private capital, and alternative strategies, fared considerably better than the performance of things like shares and listed property trusts. And that's exactly the kind of experience we would expect to see during a significant financial and economic crisis such as the one we're going through right now. If I also want to make the point before we move on, these assets, while they tend to reduce the exposure of Sunsuper members to market volatility, they are not immune to what is a very, very major market downturn. So the assets provide some defensive characteristics, but they do not provide immunity against such a major, major global downturn. If I look at the next slide, what we've done, I just wanted to also, another thing which has been in the press quite a lot of late is what's happened to the value of unlisted assets held by major super funds. Now, it's very, very hard to get a handle on what each individual super fund is doing, so I can only speak for Sunsuper. But during the March quarter, it became very, very clear to us that the value of our unlisted assets would need to be adjusted downwards to reflect the fact that this is a very, very major market disruption. So during the March quarter, our unlisted asset valuations were adjusted, but we did bring forward the timing of the revaluation process, of the valuation process of many of our unlisted assets. And we did that to reflect the new market reality, but also most crucially, to ensure that the unit prices that we offer to members on a daily basis, we are required to ensure that those unit prices reflect the fair value of the assets we hold on behalf of members. And so those assets have adjusted down in value. And so what I've shown you on this table is just how far down, or just the returns from these key alternative and unlisted assets during the March quarter. And clearly there's been a fairly significant impact from the downturn in the global economy, or the Australian economy and the global economy. However, again, as we saw during the GFC, the value of these assets does tend to hold up relatively well compared to what happens in publicly traded markets such as shares. And that's certainly what we saw during the GFC. It's also what we've seen now. Needless to say, we will continue to adjust valuations of our assets in either direction as circumstances require. Because as I've said, we need to maintain a fair unit price for our members to transact at for all our diversified investment options. Go to the next slide, Josh. So I just want to sum up by talking a bit about what Sunsuper is doing during the crisis. Firstly, in an asset allocation sense, share markets have fallen very, very sharply. And at the same time, long-term interest rates around the world have also fallen from what were very, very low levels to begin with. What this means is that the future returns from shares now look even more attractive than they did prior to the crisis. That shares now offer exceptionally attractive value compared to cash and term deposits and government bonds. We've taken a step during the March quarter to modestly increase our exposure to Australian and international shares. We've done that because we believe that will boost members' returns over the medium to longer term. We've also noted, as I've mentioned, that the demands for liquidity have increased, both from members wanting to switch into more conservative investments such as cash, but also from the government's decision to relax the early release guidelines. Our liquidity position remains strong. Based on the evidence we've seen to date, both from members' switching activity and the requests that we've had from the ATO to release members' funds, the liquidity demands are well within what we have allowed for and well within the kind of ranges that we have long stress tested for. So I stress again, the Sunsuper liquidity position remains very, very strong. not just to meet members' demands, but also to make sure that we have the dry powder, if you like, to be able to take advantage of investment opportunities that inevitably emerge during a crisis such as this. And finally, I reiterate the point about unlisted assets. Our unlisted assets are not immune to a major market downturn, and we have taken the opportunity, and indeed we are required to adjust those assets in response to the new market and economic reality. And we stand ready to adjust the value of those assets further to ensure that we deliver a fair market price to members, but also to ensure that the underlying value of these assets is truly reflected both in unit prices and in Sunsuper's investment performance. And with that, I think I'll hand you back to Josh.
Thanks, Brian. So I will hand back to Brian in a moment just to talk about how this has translated to our investment performance. But before I do, I just wanted to pick up on a couple of points and talk about how this actually translates to you. As Brian mentioned, we do diversify broadly for the reasons that Brian has spoken to, and that is to ensure that there's different exposures, and it also takes advantage of the fact that those different exposures to different assets behave differently. So it's important to note that although we've seen a dramatic impact in particular on share markets, that for the majority of our members, share markets only make up a part of what their investments are actually doing. So if I think about our two major investment options here at Sunsuper, our balanced and retirement options, where most of our members do find themselves invested, what you can see is that the balanced option has about 50% exposure to share markets, but then has exposure to other asset classes, as Brian has spoken to. And this is very important when we come to look at investment performance and try and separate that from a lot of concerns people have had purely about the investment performance of equity markets. When you look at the retirement option, that exposure is reduced from about 50% to far less. And what that means is that for those members that are approaching retirement, who may actually be in our life cycle strategy that progressively moves our members from the balanced to the retirement option from the age of 55 to 65, it means that for them, their exposure to share markets in particular is reduced. And what that means is as well that when markets do recover, which as Brian said they will, that exposure will also allow them to take part in that market recovery. So I'd just like to hand back to Brian just to look at how this translates to our investment performance and just some observations on that.
Thanks very much, Josh. Now, what this chart shows is the performance of Sunsuper's balanced and retirement options against the median fund, or at least as measured by Super Ratings. Now, a couple of comments here. Firstly, at Sunsuper, we have virtually no control as to where we are going to sit in any particular performance survey over any given month or quarter or year. It's not the way we design portfolios. What we do is to design portfolios in such a way that firstly, they maximise our members' chances of meeting the return objectives that are contained in our product disclosure statements. The real returns that members that we need to deliver for members so that they can enjoy a comfortable retirement. And secondly, to make sure that we're competitive against against competing funds over the medium to longer term. By that I mean sort of 3, 5, 7, 10 years. Now, over the year, you've seen a fairly significant fall in markets, and you've seen a decline over the year in both the retirement option and indeed the balanced option. A couple of points, again, as Josh has reiterated, the fall we've seen is significantly less than the declines we've seen in share markets. And that's what you should expect, given that we are not just solely invested in shares. The second comment I'd make is over the year, we have underperformed the typical median fund out there. And it's not altogether clear why, but one thing that we are sort of focused on is, given just what's happened in markets and how volatile markets have been, there are some funds that have taken early steps to adjust the valuations of their unlisted assets, some super being one. There are some funds that perhaps have yet to do so. But over time, those valuations will be adjusted really across the board to reflect the new reality. So the final point I'd note is that while you have seen a very, very disappointing period for markets in the last few months, really unprecedented, over the medium to longer term, are these funds actually delivering the kind of returns that are contained in the product disclosure statement? Are the real long-term returns still consistent with the objectives that we put into those statements? And the answer is yes. And finally, we have seen a recovery in markets over recent weeks. It's unclear how sustainable that recovery is. Clearly, any kind of recovery is good news, but I would caution that it's still a very, very uncertain global environment. There's still a lot of risks and uncertainties out there, so we can't be sure that we won't see another significant market downturn before we see a more sustainable recovery. And with that, I'll hand you back to Josh.
Thanks, Brian. So this is all important because, as we said in the opening, there are decisions that you may make now, especially in these uncertain times, that could have a long-lasting impact. And I think in the current superannuation environment, there's two that we're seeing people take, and these are completely understandable, and we know that a lot of people are taking these decisions because they see no other choice. And those two decisions are, firstly, as Brian has already talked to, that we are seeing a significant number of members change their investments, particularly to make those more conservative. The other thing that we're seeing, though, is that people are having to make the decision to withdraw money from their super with the early release provision that the government has allowed in their economic response to COVID. Now, as I said, both of these decisions we know many people feel they need to make, and certainly in regard to early access, many people simply will have no other choice in order to actually meet their day-to-day needs. But in making these decisions, whatever they may be, there's three things that you need to consider. The first is that by making a decision to change investments or to actually withdraw some capital from your super, what you're effectively going to do is lock in the short-term losses that we have had over recent months. In other words, you're removing that money from the system at the low point, and there will be no ability for it to actually regain. A good analogy I can give you is probably thinking about your own home if you own it, that you certainly wouldn't sell your home unless you really had to if there was a significant property downturn. The second thing to consider is that you'll miss out, as we saw following the GFC, and we'll come to this in a moment, you'll miss out on any potential market rebound. So after the GFC, we did see significant growth in share markets as well as the alternatives that Brian has spoken to. And by actually removing yourself from those markets at the depths of the crisis, such as now, means that you also lose the advantage of actually regaining that money and being part of that market regain and that market growth in the years ahead. And the third thing that I will come to now is that you'll also miss the impact of compound interest. That by taking money out from your super, either through a withdrawal or through an investment switch to something more conservative, is that if that actually reduces the interest you'll earn, and that interest is compounded year on year on year, you could actually have a more significant impact than you otherwise imagine. So if I do come to that point, what we're actually seeing is that in today's dollars, that if you make the decision to withdraw from your super now, and if we look at someone who is age 25, that could mean that at the point of retirement, again in today's dollars, they could actually find that they're more than $55,000 worse off than they otherwise would be today. Now, you add inflation onto that may occur in the 40 years or so until their retirement, and that number could be significantly more than that. Even for a 35-year-old, we'd see that the impact in today's dollars is going to be more than $40,000. Or thinking about someone close to retirement, a 55-year-old, even though they're only 10 or so years out from retirement, making a withdrawal of $20,000 today, which is allowable under the new early release provisions, mean that they could actually be losing out on nearly $30,000 value at retirement. And again, these don't account for inflation, which could actually make those numbers much more significant. If I look back on history and come to the point of missing out on market recovery, what we've got in this chart here is we're tracking two members, one who is invested in the balanced option and the other invested in our retirement option. Both of them started with $300,000 just prior to the global financial crisis. And in this illustration, we've actually chosen someone who has retired at that point. So in this chart, you're not just seeing the returns that they've made in the 10 years following the GFC, but this is actually the returns they've made after receiving a pension income over that period of at least 4 to 5% income each year. So what you can see is we've also tracked what if that person decided just prior to the depth of the GFC that Brian actually alluded to, what if that person decided to move from the balanced option, which is shown in the dark blue, to the cash option, which is actually shown here in the yellow? Or what if they move from the retirement option, which as you can see did not go down as far as the balanced option at the GFC, but it also took advantage of the recovery in the 10 years since? What if that person in fact moved to the cash option as well, which is shown in the light blue? And what you can see is by moving to a more conservative option, they have locked in their losses or crystallised those losses. They've also not been able to take advantage of the market recovery that occurred in the 10 years following the GFC. And thirdly, what you're also seeing is, as I mentioned, these examples are based on a pension member who is drawing down income each year from their super. And so that is actually further dragging on the small amount of investment earnings that the cash option is actually providing to them. So it is important that when you come to consider decisions with your super, particularly if you're deciding around investment changes, there's three things that you should think about. And these should not change regardless of the market conditions and circumstances. The first is to think about what stage of life you're in. Are you actually invested appropriately for how close you are to retirement, noting that your retirement could actually go for 20 years or more, and that still provides investment opportunity, albeit that you may want to be more conservative. Think too about your appetite for risk. If you've actually lost a lot of sleep regarding your superannuation balance, in this case, over the last few months, it probably means that you may not have actually had the right risk profile or the right exposure that you otherwise should have had. So it may be an important time to think about, on the assumption that we will have other crises in the future, whether you are actually comfortable to experience that. On the flip side, we're also seeing people who have a more aggressive risk appetite at the moment may actually be shifting some of their exposure into shares or other growth investments to take advantage of the low value of some of the assets and investments out there. The third thing that you should consider is your financial goals. Actually aware of what you're wanting to achieve. And let me put it to you this way, that if you're close to retirement, you may have seen your balance decrease in recent times, but that balance may still be largely sufficient to provide you the income that you want in retirement. What that may mean is that you can actually make a decision to invest differently or to change your exposure. On the opposite side, someone who's actually seen their balance decrease significantly and may be wanting to actually grow that balance into the future when they're able, may want to think about making further contributions and using their investments in a way to actually apply that compound interest effect to those. I think it's important to consider that our enduring advice, regardless of the circumstances that you find yourself in, regardless of the times we find ourselves in, is that unless one of these three things changes significantly for you, it's probably important to consider whether you should actually make a change to your investments. And we do encourage you to speak to us or to speak to a financial advisor if that is something that you are wanting to do and wanting to consider further. There are 4 other things to think about in regard to the impact of the current crisis. Again, particularly, this is going to affect especially those who are closer to retirement, but I would also suggest for those younger people who are making a decision where they've got no alternate to actually withdraw some money from their super, that this is an impact they will have to consider into the future. The first is, will you actually see a reduction in your balance, a reduction in the ability to recover that balance when the market recovers? And are you as a result going to have to shift your income expectations for retirement? To my earlier point, will your balance be sufficient to actually give you the income that you want in retirement? Or are you actually going to think about whether you have to change the way your lifestyle will look in retirement based on where your balance may be? The second thing may be, and again, we did see this following the global financial crisis, that where people were employed and able, they may have had to make the decision to actually effectively put on hold or defer their plans for retirement to give themselves time to actually get some market recovery, but also to give themselves time to make additional contributions into their super to help their balance recover. The third thing to think about is if you are in a position where you are thinking that your balance may not provide you the income that you want in retirement, will you actually now find yourself eligible for the age pension where you may not have previously been able to? Have you seen falls in asset values that actually means that you might now qualify for the age pension or qualify for more age pension than you otherwise would have? The other thing to think about is, as part of its economic stimulus, the government has actually made some changes to the asset tests that apply to the age pension. They have also made changes to the amount of income that you would otherwise be required to withdraw from your super in retirement. These two things combined mean that some people may actually see a change in their age pension allowance as a result of that. The fourth and final thing that I would actually say here is that if you are close to retirement, do you have opportunities to actually think about, or will there be a time in the future where you'll be able to think about taking advantage of putting additional monies into your super? Now, the reason why I raise it is, especially in these times of uncertainty, including employment and salary uncertainty, there are times where if you make a contribution to your super or your spouse makes a contribution to your super on your behalf, that you may see some government kick in to actually grow your super further. There may be the government co-contribution that will grow any contribution you yourself put in, or you may also find you're eligible where you contribute for your spouse to yourself, receive a tax offset for doing so. We appreciate, though, that in these times it is difficult for some to consider making further contributions to super, but we would certainly encourage you to think about it in the times ahead when you're able to. So to assist in both those and a number of things that we've covered today, we do have available 2 other webinars that we've recorded over recent weeks. The first that goes into more detail for those of you who are having to consider whether you make a withdrawal from your super to assist you through these times. And we've also made a webinar that helps those who are close to retirement to weigh up and consider the opportunities as well as the options and perhaps hard decisions that they may need to make in the months and perhaps the years ahead. We also encourage you to visit our dedicated COVID page at sunsuper.com.au/COVID-19, which hosts both these videos, but also hosts significant information that we've only touched on today. And especially in the case of Brian, he has been working very hard to provide up-to-date and very tangible information on that page for our members to access. So I do encourage you, if today has caused you any further questions, if it has caused you to consider taking some form of action, please do give us a call on 13 11 84, or where you have your own financial advisor, we encourage you to engage with them to speak about what we have raised with you. I also encourage you again to visit our website, which has significant amounts of information available to assist you through these times, including if you are in financial stress or distress and actually need access to financial assistance immediately. On behalf of Brian and myself, as well as the entire team here at SunSuper, I would like to thank you for taking part in today's webinar. We do hope that it's been beneficial, and please keep an eye out for webinars and events that we will be conducting in the weeks and the months ahead. We wish you good fortune for the future and that you are taking care of yourself. Thank you very much.